Hello, everyone. Welcome back to Signal or Noise, episode 20. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, we got to start with the Super Bowl. Congrats. I know you're a big Chiefs fan. Tell me what you thought of the game, and do you think now it's official? Is this a dynasty? 3 Super Bowls the last 5 years? What do you think?
It's surreal for everybody in Kansas City because there was a point where we went 30 years without a championship in any major kind between the Royals and the Chiefs, and then after 30 years, the Chiefs won now, or the Royals won. Now you've got the Chiefs winning 5 Super Bowls, and having so lost a generation and a half to watching other dynasties. It's surreal in Kansas City to watch a game be down and have a pretty good degree of confidence that things are going to work out. Work is usually on the reverse side of that, but I think Mahomes has proven. I mean, if he can do it this year when it was supposed to be their off year, they're missing all their talent, really hard schedule, less days off than any other team, underdog on the road, it's just crazy. I mean, so I think he's got a lot more in him if he stays healthy, and it's just a really, telling my family it's just you're watching something that people will be talking about generations from now. You're really watching greatness.
Yeah, he's got to be now and mentioned in with the other names there. I think only Montana has 4, Bradshaw has 4, and Brady has 7, right? Nobody else, right? Aikman had 3, but he's right there with them, and no team has ever won 3 in a row. So, I mean, uh, maybe they'll be an underdog again next year. I don't think
I
so
don't think
after
so.
this, but that shocked the both of us. I mean, surprised the both of us. They were underdogs, and so I had to root for them. I always root for the underdog, and they pulled it out. It was a close game, but for sure, I think this is going to be the most watched Super Bowl in history. Last year was actually number one, 115 million. I think definitely that's going to surpass that. In terms of what Americans watch, the most watched event, only like the moon landing in 1969 exceeds the Super Bowl. We love the Super Bowl. It's something, unlike other sports, it's one game, right, that decides everything. You don't have these long series. So I think that's part of it, but it's just a cultural thing. And why do I think we're going to exceed that? Well, number one would have to be Taylor Swift and the fact that more people said they were going to watch it going in. I think 72%. That was up from 66% last year. And just that younger generation, 18 to 34, saying 41% of them saying they're going to watch because of Taylor Swift. I know my 2 daughters never been interested in the Super Bowl before, and definitely they watched it more this year than ever before. And it's just phenomenal. I know you're a Swiftie, Peter. This is kind of, you couldn't have scripted it better than this. And there's a lot of conspiracy theories out there saying that this is what the NFL wanted and they pushed their way to get the Chiefs to this. I don't know how you could have planned that in terms of the way this game ended, but it really couldn't have ended any better for the NFL in terms of Kelsey and Swift and all
No,
the
it,
rest of
it
it.
it couldn't. And we had a few dozen people at our house last night, and there were a whole bunch of young girls sitting right in front of the TV, particularly for the halftime show. They didn't even know who Usher was, but they were there in case there was going to be Taylor dancing to Usher on camera. So yeah, they definitely got a lot more eyeballs this Super Bowl than they will get with any future Super Bowl, I think.
Yeah, and a lot of people were complaining, a lot of haters were complaining about the Swift, the camera going to her throughout the season. And my son was in that camp. Well, it was a football game. Why do we have to show her? I explained to him this chart here. I said, listen, you're a real football fan. You're gonna watch the game no matter what. You're not gonna change the channel if they put it on Taylor. But if they put it on Taylor, this whole group of other people are gonna stay watching it. And this is a big demographic for them. So if it were me, I said I would have a box in the corner of the screen with her the entire game, and that would annoy
Uh,
the football fans to no end. But they would still watch it, and you would keep all those other eyeballs there.
Now that's a streaming idea. I'm surprised somebody didn't just point their iPhone at Taylor, just live stream her
Yeah,
100% of the game. That would have had millions and millions of followers.
right. She doesn't need the money, but I'm sure someone approached her with that idea. In terms of ad revenue, remember when it used to be like $1 million to buy an ad? It wasn't that long ago. Now it's $7 million for these 30-second ads, and just incredible increase since 2010, 169% increase over that period of time, well above the rate of inflation. So just people trying to get this captivated audience, and probably some of that knowing that this is going to be a record year. And is this number? What do you think overall? On do companies get the value that they put in terms of buying that 30 seconds, or do you think it's overinflated at this point?
I think it's a bargain. And I think that because I think our society has become so fragmented, right? You go from three channels to cable to Springsteen wrote a song, I think 57 channels, nothing wrong on, and that was like crazy back then because there were so many channels. And now, thousands of channels, tons of streaming services. If a show is insanely highly rated, it's getting the tiniest fragment of what a Friends or a Seinfeld or something would have gotten 10 or 20 years ago. This is one of the only things left, if not the only thing left on TV where everyone's coming together and watching it. And because people spend so much on the commercials, a lot of people are interested in what the commercials will be. So they're actually watching the commercials, and it's an event that's not really recorded and watched later. It's watched live, right? So if you buy an ad on 60 Minutes, or Law and Order, some percentage of people are skipping those ads. They're recording and skipping. So I think you've got a perfect storm of everything that actually makes this a bargain. I was surprised at how the ads just were not good this year, with the exception, I thought, of the Dunkin' Donuts ad, which I give a thumbs up. That was a incredible ad, but for the most part, it was kind of surprising. There have been years where there have been just a lot of incredible commercials. This is not one of those years.
Okay. So, but regardless, you think the brand, they got their money's worth in
Totally
terms of the
worth, totally
brand
worth it. What do you
awareness
think?
alone.
What do you
Yeah.
think?
Yeah. It's hard to quantify, right? This type of thing. It's just, at these types of numbers, these are companies are so big nowadays. It's almost, it's almost nothing for most of them. So
Yes,
why not try it, right? I don't know if they could, if they don't do it, they risk that competitor coming in, right, and doing it. Now that's, to them, that's as much of a threat, right, as not doing it at all. But in terms of records, we also have a record ticket price. This is kind of crazy, $10,000, and they didn't have any trouble. Look like the stadium selling these tickets. This was the average resale price, $9,800, almost 10,000. You look at family of four, $40,000. And to me, Peter, this is shocking. It's well above where it was last year. I think 70% higher than last year, and 40% above the previous peak in 2021. But to me, it just shows you that in terms of the recession predictions and things like that, like the consumer is still there. There's still demand, and live events have, and we talked about this last year, are 100% back from pre-COVID, and I think that's a great thing to see. But $10,000 a ticket, kind of unbelievable.
Yeah, more than 100% back. Whatever tickets were going for anything to any live event before COVID, they're not just back; they're back plus inflation plus another
Yeah.
factor. That all put together, that's taken all of this to an entirely new level. I do wonder how much of this was that it's San Francisco and you have so many multimillionaires so nearby with a team
Mm.
that hasn't won in so long. And I thought that was the reason, but a lot of my friends that were in Vegas said they were seeing 10 Chiefs jerseys for every one
Oh,
49ers
really?
jersey, and so I
Yeah.
maybe that wasn't the reason.
It was hard to tell from the crowd, like, who they were. It seemed pretty, I would say, pretty evenly balanced. I don't know, but
Yeah,
yeah, yeah. That tech factor definitely, it definitely didn't hurt. Let's put it that
no,
way. All right,
understood.
so let's move on. Number two here, we often talk about equity returns when people ask, well, what do stocks do in the long run? We always throw out that 10% number, and it's accurate, right? That's what they've done. If we go back to 1928, really most long periods, if you're looking at rolling 30-year, 40-year periods, you tend to get to that 10% number. In the future, will it be 10%? We don't know, but that's our best guess based on a long period of history. But often questions, right, from clients arise because there's a deviation from that 10%. And when they start out, you don't know if it's going to start out at the start of a big bear market or big bull market or perhaps a sideways market, but it's almost never, at least initially, around that 10% return. So I just wanted to illustrate that here, looking at what a trend line would look like going back to the inception of the S&P Total Return Index in September 1989. that dark blue line is showing you that smooth path if you had just earned 10% a year. And of course, we would love that. Sign us up. But we can see here investors aren't rational. And two periods of time I think really prove this. And that irrationality leads to irrational exuberance at times and what I call irrational despondency at times. And I think in the past 40 years, the best example of this have been March 2000 and early 2009. So extreme greed in 2000, extreme fear in 2009, and that led to huge deviations from what you would say that trend line, that 10% trend line long term. So 100% above it in 2000, 50% below it in 2009. Is this concept something that can be explained and coached to investors as they go along, or is it just something they have to appreciate over time and learn that in the short run, that 10% is anything but guaranteed?
I think the investors just have to learn that volatility, risk, and risk of loss are different things. The price you pay for investing in equities in a diversified large cap portfolio or any diversified portfolio of stocks, the price you pay is volatility. And if there's no volatility, you're not going to get the return. That's why you get the return, is because you're paying the price of volatility. Otherwise, everyone would just buy bonds if the return was going to be the same. And if you can look at it that way, you can not only get over the volatility, but you embrace it. Because if there was ever a day where volatility was gone, so would your returns. The return premium you get would be gone. And so you've really arrived as an investor when you're excited about even downside volatility, because you know that outperformance you're going to get from the bond market is going to persist longer. And that's when not when you can tolerate it, but when you truly embrace it, you've arrived.
So did you know, or what were you telling people in early 2009 who maybe had started, a couple of decades before? Now they were looking at that 6% annualized return. They were promised to get 10%, and you had to believe, you had to have the faith to say, well, it's going to even out, and we're going to have the upside to bring us back to 10. And those must have been difficult conversations, I'm sure, at the time.
I think what's hard for people is when it's at the bottom, even the people that believe it's going to come back, they go, oh, well, now I've got to earn 6% or 10% a year for the next however many years to get back to even. And that's
Yeah.
not really how it works. When you have very steep pullbacks, it's usually because a storm has come in. And when we see signs that the storm is going to subside, the market immediately recovers from that loss. It's like a roadblock in front of a restaurant. And when they say, hey, the roadblock's going to be removed Friday, well, the restaurant goes up in value immediately. It doesn't go up 6% a year for the next 10 years. And we saw that with COVID. We saw it in 08, 09. And I think that's what gets people shaken up. They might believe it's going to recover, but they think the years it will take to get back to even are so long. And that's not generally how it works.
Yeah, I think even harder may be the period of the 90s. If you happen to get lucky early on and not getting overconfident or not assuming that is likely to persist. And, going back to 2000, it's probably hard to remember what everyone was thinking at that time. But there was a lot of people saying like 20% is the new 10%
Right.
because we saw five straight 20% years, and it seemed like, okay, this type of growth, this paradigm shift is here and it's going to continue. Are there any parallels with today? It doesn't, if I go back to this chart here, it doesn't seem like we're very extreme above the trend line here. If we're 6% above that long term 10% trend line, it doesn't seem extreme in either direction like we were in 2000 or 2009. Which might be surprising to people because we've had a great run the last 10 years, but nothing like obviously what we saw in the 1990s. Does it feel like we're kind of maybe in the middle? And that, not to say that means anything, right? We could have a bear market, or we could have a strong continued run higher from here. But does that provide some comfort to you in terms of maybe we're not at the extreme a lot of people are saying?
Yeah, I don't think we're an extreme at all. I think there's so much recency bias. We look at the last couple of months, look at the run up, but but before that, there was 2 years of nothing. If the market just went up 3% a year for the last couple of years, no one would be saying we've had this amazing run up. It's just the sequence of returns, I think, is what really, I don't want to say confuses. It's just, it really influences the way people think, is that sequence of returns.
Yeah, you can't pick and choose when you're going to start. right? We'd all love to start in 1994 in December. I mean,
Yeah.
that would be fantastic, but it's nearly impossible. And listen, what I tell people is even if you started at the peak in 2000, is that you were starting your career, that wasn't necessarily the worst time because if you look at the dollar cost average returns like 10 years out, they were pretty good because you had that chance to buy after, 3 straight down years and so on and so forth. So, um, taking that longer term view, very difficult, but just be prepared. That 10% return is not likely what you're going to experience unless you go out 30, 20, 30, 40 years. The longer you go out, what we can say is closer you're going to get to that, let's say 9 to 11% range. Okay. We got to go back to NVIDIA, Peter. And people might be asking this question. They were asking it last year. Is NVIDIA a bubble? They're still asking it today. And this is a difficult question to answer. When does a bubble actually become a bubble? And there's this famous quote by George Soros that I always refer to when people start talking about a bubble. He said, when I see a bubble forming, I rush in to buy, adding fuel to the fire. That is not irrational. And the logic there is that it's not irrational because people are not rational. And so his thought is if you see a bubble forming and you immediately buy that, well, there's going to be many other irrational people
Right.
that are going to jump in after that. And certainly we've seen that over the past year. Nvidia was already up tremendously, and now it's just continued to run here. This is a kind of an incredible stat. In February 2019, so just 5 years ago, $89 billion market cap. Today, approaching 1.8 trillion. That's a 20x increase in 5 years. We've never seen that, of course, for a company this large. But back to that question, is this a bubble? Like, could you say it over here? Yeah, you could have said it's a bubble. Could you say it here? Yeah, yeah. So it's like every step higher, it seems irrational. But is it a bubble? And should you do what Soros says or should you do nothing? What should an investor make of NVIDIA today?
There's no question that momentum is a real thing. Momentum is very real. I think the question here is, do you believe there's a moat? Right? So the product is here to stay. Artificial intelligence is here to stay. Everything is going to grow exponentially quicker. They seem to have the pole position here. Um, but is it like companies that have a real moat? Like I can't imagine, with my iPhone leaving this ecosystem, right? And somebody described to me if I had to not have my iPhone for the rest of my life or not have my a finger, I would give up the finger. And I think most people would. That's how strong the Apple ecosystem is. So when you see that multi-trillion-dollar market cap, you can make sense of it. Same with Microsoft, right? You can make sense of it. I view this, and just to make a bunch of people mad all at once, I view this the way I view Tesla. First movers, extremely innovative, forward-thinking leadership, a real innovative product that's changing the world, but without a long-term moat. That at some point, others are going to enter this space. The whole saying about capitalism, your profit margin's my opportunity, right? And I think that that's what we're going to see here. And the question is, how long is that gap? And I don't know how long that gap. How long is it before viable competitors can come forward with a comparable product? Is it 2 years? Is it 12 years? I don't know what the answer is to that, but it's hard to see this having the same sustained competitive advantage as an Apple or a Microsoft. I know you've done a lot on this. Your charts on this get a huge amount of attention. What opinion have you developed around this?
So I've been quiet on the bubble thing until recently here, and this kind of last week I did this analysis, kind of comparing Nvidia to the entire energy sector in the S&P 500, and these are companies we're all familiar with: Exxon, Chevron, Conoco, and the fascinating thing is that Nvidia's market cap now exceeds that. And at first, you might say, "Well, yeah, Nvidia's a better company, it has more growth, all the rest of it." But the way I look at it today is it's pricing in that future as it already happened, that everything good that investors are thinking about will happen and there won't be any competition to bring down margins to take share from Nvidia. 19 billion in terms of net income for Nvidia, 147 for the energy sector. billion. Now we know Nvidia is growing very rapidly. Maybe that'll be 40 billion next year. Could very well be. But is it going to be 100 billion in 5 years or 10 years? Maybe, but that would be such incredible growth for a company this size. We've never seen that before. Maybe it'll happen, but my bet is that other entrants will come in and at least fight to get that share, and they're going to do it at lower prices and lower profit margins. It's just too it's unreasonable to think that this is a 50% margin business
Right.
forever, which I think what investors are kind of pricing that in today. Now, where maybe it stays at that 1.8 trillion for the next 10 years, right? Or maybe it goes to 3 trillion and then it crashes down. I don't know the pathway, but to me, here today, I would say expectations are extremely, extremely high looking at this. And if it, the other stat here that's worth more than the entire Chinese stock market that you tweeted out, nothing to see here. And if you're coming back to a bubble, like what's the question? There's a textbook definition. It's hard to define it, but Wikipedia says it's an asset at a price that strongly exceeds its intrinsic value. Okay, we could debate what is its intrinsic value, never ending, but this is, I think, the more reasonable definition, which is it's based on implausible views about the future. And to me, it's implausible that there won't be more significant competition, and investors are not appreciating that threat. We had the news last week that Sam Altman, OpenAI, is trying to drum up. I mean, they use the word trillions. I don't know how that's possible, but trillions of dollars to compete with Nvidia. They don't want to be so reliant, right, on this to drive the future of their business. And you could believe that Google and Apple and Amazon and Microsoft don't want to be reliant on this one company as well, and they have the resources to invest in this, right, as competition. So, what I would say is that it's pulled forward a lot of the future returns that will come, like, if Nvidia exceeds expectations. But will it be able to exceed these already lofty expectations? I don't know. And to me, Nvidia now almost has the same market cap as Google and Amazon, and you see its revenues 45 billion. Yes, that's going to go way up this year, but nowhere near Google at over 300 billion, Amazon 575 billion. It's trading, of course, Nvidia 40 times sales versus 6 for Google and 3 times for Amazon. So that's 40 times sales number. Very difficult. You mentioned Tesla traded at 30 times sales a few years ago. It's well now below that price. So the expectations very, very high. Nothing's impossible. Could they exceed those expectations? Maybe, but to me, that would mean that there's something wrong with the competitive landscape in this space.
Completely agree. I just, if you told me I had to like own one of these for the next 20 years, I'm taking Amazon over Nvidia. But we'll see. It's going to be a story that's going to unfold, and I'm sure it'll have a hell of a run for a little bit here. So we'll hear a lot about it.
Yeah, and the right answer for investors is, in terms of should you just own Nvidia? Of course not. You have it in your portfolio and it's growing, right? You've seen it grow, and there will be another Nvidia. No one thought 5 years ago Nvidia was going to be the next Nvidia, and there'll be another company today that is similar to that. All right, I want to talk about controlling inputs here. Peter, walk us through this tweet you put out. I loved it. I felt when you put out these tweets, I feel like you're speaking to me directly, and great message here. What were you trying to get across?
I really think about I do think a lot about like what are my inputs in my life. Like if I'm gonna go give a presentation, I make sure that I am listening to good music or so. I don't want any negative things coming. I'm not checking my email before I get on stage and give a presentation. I am a big believer of the inputs, incredibly so, influence the outputs. We've all heard the saying, show me the 5 people you hang out with, and I'll tell you who you are. I hammered that in my kids when they were little, and I think it obviously goes beyond that. What do you read? What music do you listen to? Who are you working with? Um, what food are you eating? I mean, it's if you're hanging around 5 fit people, you're probably going to become more fit. And there's a lot of research around this too, and so it's the most basic thing you can do, and in terms of controlling your outcome, that requires the least effort. If you just can control what comes in, you're heavily influencing what goes out. You're making it easier on yourself to achieve with whatever you're trying to do.
Yeah, and absolutely. But what would you say to people who say it's just so hard to keep it out today, especially technology, social media? Is the answer to just put time constraints on that stuff? And they're, because it's so addictive, they make these devices so addictive. I mean, personally, what I do when I tell people is when I'm trying to get work done, I put the phone in another room, right? And I don't look at it, I don't think of it. Might annoy my wife who's trying to reach me at times, but it actually is not on your mind. And they've done these studies that just by doing that, it actually is extremely helpful. Like, do you have any tricks like that
Oh,
where
I use all kinds of things. So, one, I push all my social media apps off the homepage. Like my homepage has no shortcuts. It's just a picture of my family or my wife, and then I have to scroll to get to the swipe to get to the ones, and to get to social media, I've got to get the last one. I often use grayscale where my phone stays black and white. I put the limits that say,
Hmm.
"Hey, you've done this for more than 15 minutes." I'm doing everything I can to make it just not right in my face all day long.
Yeah, it's huge. So speaking of in your face, any it's kind of funny to look at, but the reviews so far for the Apple Vision Pro pretty good. Like across the
Yeah,
board, I haven't heard many negative reviews. $3,500, obviously not cheap, but I expect that will come down at some point.
yeah.
Are you an early adopter to this
I
type
have
of
not.
thing? And
This is
yeah,
one of those things that I think like I haven't used yet, but between this and artificial intelligence, the whole world is going to be completely different in just a couple of years. I mean, just this price is going to come obviously down. It's going to be much smaller, less intrusive, and it's going to be really, really interesting what the world looks like in just a couple of years. How about you? Have you tried this
yeah.
yet?
No, I'm not ready for. I want to get less, less screens in my face, but I'm not the target for this immediately. I'll wait till there's a more, let's say, a use case that's not. I know that you can do almost anything on it. I mean, they're talking about it has a virtual keyboard, and you could they have people like on a plane and they're like typing into air, and it's
Right.
awesome. I mean, all of that stuff is great. Like, but trying to get away from the screen, I think this is like it's just that's the exact antithesis of it. So, like, I think ultimately, if it used properly, it'll be a great productivity tool, particularly for people that travel a lot. I'm sure you could find a use case for this, but I'm still happy with a laptop at this point.
Yeah,
I'm not
it
sure I
feels like
need that.
something else that's going to have a lot of implications for aloneness and anxiety and
Yeah,
depression and all of the issues that we're facing now as people become more and more in their own little space. It feels like it's accelerating that even further. Obviously, it's progress and it's technology and it's going to do
yeah,
amazing things, and I'm going to wind up with one, but it feels like there's a lot of negatives that are going to come with it too.
yeah. No question. Okay, at some point we got to try it. Maybe we'll do an episode at some point wearing these and see see how that works. I mean, supposedly it's different in that you don't feel like you're in this kind of bubble. You can see through it, right? It's just adding to it. So
Mm.
amazing. We'll see. I don't know. Initially, I don't think it's going to be a huge because of the price point, but I think more and more that kind of stuff is coming and it's inevitable. All right, let's go to signal or noise here, Peter. First, I want to rewind and pat ourselves on the back a little bit. So we're at episode 20 now. Episode 1, we talked about the yield curve and told everyone, please don't invest or not invest in the stock market based on the yield curve. There's no real signal there. And now we have the longest yield curve inversion in history, 473 days and counting. Fed's not expected to cut rates now, maybe until May. So this inversion will continue. And let's say you sold out because of the inverted yield curve, which there were many articles back in October 2022, which happened to be near the stock market low. Let's say sold out because of this. Now you're in a very bad place. And this is why you don't want to be investing against the data because on average, the data tends to be correct and said the data suggested the market would probably be higher regardless of the inversion. And here we are, 30% higher in the S&P 500 since the yield curve first inverted. Number 2 here, episode 2, we talked about Fed funds rate. Please do not invest because the Fed is hiking rates. Now we have the S&P 500 15% higher than when they started hiking rates in March 2022. Okay, let's fast forward to today. This is the big one here. People are talking about this streak. S&P 500 up 14 out of the last 15 weeks. Great start to the year, up already over 5%. Remember we were talking about the strategist forecast? The average strategist was only forecasting 2%, a little less than 2% for the entire year. We're
Right.
already well ahead of that, which just shows you how ridiculous, again, those targets are. But is this too much, too fast, is what everyone's saying. This hasn't happened, Peter, since 1972 with the S&P 500 up 14 out of the last 15 weeks.
I don't think so, and you don't see a lot of breadth and depth there. I mean, this is really still carrying over from last year, where you see the top 7, 8 stocks really the artificial intelligence revolution really driving the returns here. And so, when you look at the overall market, you still have 2 years of a lot of nothing. And when you look at big tech, you had 2 years of nothing with a couple of months of a huge run up. And so I think we've got a long way to go. I'm making no prediction whether the market goes up or down, but I certainly don't think that it's run away from us.
Yeah. So I looked back. It happened only a handful of times since 1950. Last three times, the market was higher a year later. This was the last example in 1972. Went up 15 out of 16 weeks, and then it went sideways for a period of time, and then went higher, and ultimately peaked in January 1973. And so, is the same thing going to happen today? No, of course not. Every time is different. To be sure, something different will happen. And to your point, perhaps large caps or the big mega caps will have a period of consolidation. And as we talked about in the last signal or noise, the small cap catch up will take hold. And I think that's nobody's thinking about that, expecting that, because all the focus is on the Magnificent Seven still and Nvidia. But that could be the situation here. Who knows? But it certainly doesn't seem to be something you want to be acting on. What I always compare it to these streaks is going to the casino and it comes up red 10 times in a row or black 10 times in a row on a roulette wheel. Well, that doesn't change the odds going forward. The odds are still what they are. And similar to a coin flip. If you flip it enough times, it's going to land on heads a number of times. So don't view this alone as something. It's interesting, but not actionable. All right, Peter, covered a lot of ground today. Thanks everyone for watching. If you're watching this on YouTube, hit that like, hit that subscribe button. We're also available on Apple, Google, Spotify if you'd like to listen to audio for podcasts. And if you're an investor thinking about 2024, wondering what you should do with NVIDIA or not do with NVIDIA, reach out. Creative planning, over 200 billion assets under management and advisement. We're in all 50 states and we're here to help. So with that, we'll end right there, Peter, and we'll see you next time on Signal or Noise.